Welcome all you multifamily maniacs to the Deal Lab. I'm Dr. Heath Jones.
And I'm Hutch, the marine investor.
Today, we're going to be asking the question, how should passive investors perform due diligence on syndications? Our guest today is the founder of SAMO, S-A-M-O Financial, and loves helping people. Her passion is to empower people to build wealth for themselves and for their families through passive investments in various forms of real estate. For the past few years, she has worked tirelessly to help her investors participate in offerings of over 1,200 apartment units, $10 million in self-storage, and $10 million in mobile home parks. She offers investors education through articles and presentations and is a sought-after speaker at various real estate events. You can find out more about our guest and how you can work with her by visiting www.samofinancial.com. We would like to welcome Miss Alina Trigub. How are you doing, ma'am? How are you doing today?
Doing great. Hi, Heath. Hi, Hutch. Great to see you guys.
Hello, Miss
Nice
Alina.
meeting you. And thank you for inviting me to your podcast. I appreciate the warm introduction, and thank you for sharing my website with everyone. I noticed that typically most podcasters do that at the end. So it's very nice of you to share it at the beginning of the conversation.
Oh,
Yeah, we really appreciate you joining us. It's an honor.
Yeah, thanks for coming on. So
Thanks.
Yeah, so Alina, you definitely have a lot of experience and success in real estate. What is the one real estate quote or mantra that drives you?
So I have multiple quotes that I like in general, but one of my favorite people in the investing world has always been Warren Buffett, and Heath has probably noticed that by the quote in my signature line in my email. His investing quote that I like a lot, and it applies not just to real estate, but to all types of investing, is be fearful when others are greedy, and greedy when others are fearful. That's one of my favorites. I do have his other quote in my signature line on my business card, and I think it's in my email as well, that says that someone is sitting in the shade today because someone else planted a tree a long time ago. I try to live by that quote, and it resonates with me a lot, and to me it speaks a lot about the person and who the person is and what are they trying to achieve in life.
Yeah, I just left work and I was talking to one of my one of the officers that I work with, about the different layers of your why, and a lot of times when you dig deep into your why, you realize that a lot of people have established a path that you can travel on, and also we have a responsibility, whether it be personal or professional responsibility, to create a path or plant a seed that could grow and blossom or grow and blossom into a beautiful tree, right? That can cover the shades for some folks later on in life, so that's a great one.
Absolutely.
Okay.
Agreed.
All right, so Lena, why don't you tell us and our audience a little bit more about yourself and how you got started in real estate?
Sure, absolutely. So I started investing in real estate about 7 or so years ago. I've always wanted to invest in real estate, but never really took action until that time, 7 or 8 years ago. My background in general is in accounting and taxes, so I'm a former tax accountant. I left the field a long time ago, but taxes have been on my mind for many, many years. And mainly because while my husband and I were growing in our careers, I noticed that the tax impacts have also been growing and impacting us further, especially the AMT, the alternative minimum tax. So I've always been thinking about finding a way to mitigate and minimize the tax impact, and hence real estate has been choice number one for many years. So when I finally started researching real estate, I realized that there are ways for people to invest, but not be completely involved in real estate, do it passively, sort of through syndications. So after doing the additional research, I decided to give it a try, and I invested myself as an equity partner in one syndication, then another, and then another, and then I saw the trickle-down effect of it. And after doing it for a few years and seeing the benefits that I had, not only in terms of being taxed at a lower tax bracket for that income, but also in terms of doing it completely passively without any interruption to your day-to-day life. I decided that this was a great investment strategy that I wanted to share with other people. And out of this idea, my company, SAMO Financial, was born to simply help other people so that they can find that shade under the tree many years down the road and reap the rewards of building their wealth passively by investing in syndications and investing in many, many different assets. So it's not just apartments, as most of us have started investing with apartment complexes, including myself, simply because it's close to home. It's something we understand. That I lived in that workforce housing at some point in my life, so I understood that asset class very well. But then also investing in such assets as mobile home parks or assisted living and storage and whatnot. I mean, the opportunities are endless, and the ways to diversify are unlimited as well. And that's what makes the investing in syndications a great strategy, I think. So that's where I'm at today with my company and helping other folks to build their wealth passively.
Yeah, that diversification is widely misunderstood sometimes, right? And I'm pretty sure you have experience with talking to a lot of passive investors who have a lot of their money in the stock markets, and they talk about different mutual funds and different stocks that they are invested in, whether it be financial sector or tech sector, so on and so forth. And they feel as if that is diversified, but they do not have control of how that the market reacts to something that happened in Greece that I don't know how that affects stock market in America, but somehow it does, right? Real estate does give some true diversification. And even in the real estate sector itself, there's even further diversification, as you mentioned, mobile home parks, storage, apartment buildings, commercial buildings, so on and so forth.
Yeah. So Hutch, you made a great point about not knowing how the changes in Greece would impact the stock market in US or Europe, for that matter. That's the thing with the stock market. When you're investing in something, and I typically use the example of Starbucks because I like drinking coffee. If you and I start drinking Starbucks coffee 6 times a day instead of once a day, it will have absolutely no impact on the Starbucks stock. And that's the problem. Like we have no way of controlling that stock, and no way of mitigating the impact that that stock has, and how, but that may or may not impact our portfolio in some way. Where with real estate, the syndications, even if someone is investing passively in syndications and not having a control, they do have full involvement, and they are fully aware of the strategy that the operator has decided to take with that particular asset, and they are kept up to date as to what's going on with the property, and they know how the operator is planning to implement the strategy, increase income, decrease expenses, and overall increase the bottom line. So that's the beauty of real estate. Not to say that it doesn't have any challenges. Everything has challenges, and it's not FDIC insured and whatnot. There's risks involved, as we know, and COVID-19 is impacting real estate just like any other industry. But the risks in real estate can be mitigated and can be worked on. Where with the stock market, it's completely like throwing a dart in the dark.
That's right. No, you're exactly right, because one thing you get to do as a passive investor is you get to buy into the strategic plan at the front end. And so you can decide whether or not that plan that a sponsor is presenting to you is something that you think will work or agree with. And so that's one thing we're going to get into in this episode that I'm really excited about, is how do you decide which strategic plan is one to go with. And so, but before that, I'm sure that even before you invest as a passive investor, you have to have the right mindset, right? I mean, you're going to be pulling out a huge chunk of your retirement, or maybe all of your retirement. How do you mentally prepare yourself to do that, to take all this money from somewhere that you've been taught your whole life is safe, and now hand it over to someone that you may have just met at a conference, or, how do you mentally prepare yourself as a passive investor to do that?
Sure, Heath. So first of all, I strongly discourage anyone and everyone from investing their last lifetime savings or the last money they have without having an emergency fund. And this is one of the required questions on my list to potential investors when I interview them, whether they have an emergency money set up someplace else. If they don't, then I will not allow them to invest without I won't even consider them. One of my other questions to passive investors is typically how much money are they planning to invest? Because if they plan to invest in one syndication and that's it, I tell them upfront, then from a tax standpoint, it's not going to benefit them at all. Not to say that they can't do it, they can, but if there are no benefits, then why bother investing? And what I typically suggest is to wait a little longer and try to accumulate additional funds and be able to invest in at least a couple of syndications. They don't have to do it at once. They can do it gradually over a period of time, but they want to be able to use the tax advantages that are offered through passive real estate investing. So they should definitely consider investing in multiple opportunities. And then another thing that I try to encourage investors is if they want to invest, they need to understand what they're doing, and that is simple. They in order to do that, they have to educate themselves. If someone is educated, they start asking educated questions and start understanding the process and what they're going for. Once they understand what they're doing, there's a reason why they call it sophisticated investors, right? Forget about 506C or B rules, but in order to be a sophisticated investor, you need to be able to understand what are you getting yourself into. And if you're not educated yourself on real estate syndications, on the type of assets you're investing in, then how can you do it? I would not allow anyone to invest with me, at least, unless the person understands the process and the type of investing they're getting themselves.
Yeah, she's already asked me my other question. What are questions you ask your passive investors, right? And one of them being, do you have an emergency fund? That's very important. And not just that shows that you are truly looking to help them. You're wanting to provide shade for them in the future, but not at the cost of the risk of not having that fallback money. So I really appreciate that. And I'm sure your investors do as well.
Sure. Yeah, and one of the reasons for that is, number one, I do care about them. And number two, I want to protect myself and my business. I'm here to stay for a very, very long time. So my name, my brand name, my reputation is very important to me. So if I'm telling them upfront what I think and what I see and how I do things, that tells them how we do business at our company at SAMO. And if they want to work with us long term, but they simply not ready now, that's fine. We can reassess things in 6 months or 2 years or 5 years down the road and start working when they're ready and when we're ready to work together.
Yes, so that's great. We often hear the terms that when you get into a syndication, it's like a 5-year marriage, right? Right. So I do like the qualities that you talk about, but what are some of those mindset qualities or character attributes, even though you can never truly know somebody, right? But what are some of those character attributes that you look for whenever you are establishing or improving a relationship with a passive investors?
I think it's important, number one, to have several conversations, not just one, ideally a couple, and continue that conversation while you're working with investors after they invested with you, to truly understand where each person is coming from. It's important for investors to understand the strategy we're implementing, our long-term plans, and make sure that our plans align with their plans. And if, for instance, I'm offering someone to partner up with us on an investment that is a 5-year hold, I always tell them that, don't hold us responsible to that 5 years, because we may decide to sell it in 2 years, so we may decide to sell it in 7 or 10 years. That 5 years is just pure estimation. So I try to be fully transparent And many people will appreciate that full transparency, and it gives them a better understanding of where I'm coming from, and it opens up their eyes. So for them, in terms of the mindset, again, if someone has limited beliefs, it's simply due to lack of education. And yes, partially that's real estate education, but partially it's personal development, educating oneself on the personal development. And on the personal development end, I also have a few books that I typically recommend people to start with. Books like Miracle Morning or The Richest Man in Babylon. You know, reading that material, The Richest Man in Babylon has been written over 100 years ago. So when you read a book, which is essentially financial book that's been written 100 years ago, that is absolutely true today. I mean, it's mind-boggling, and people realize that only after digesting that. And sometimes it takes multiple attempts to digest that information, which means that you have to reread. When you reread the same content multiple times, you understand it a lot more, and you start to understand the multiple angles that the author brings into perspective, and you start to appreciate what's going on around you, and you start to look at things differently. And that's the beauty of personal development. Reading books, understanding them better, and then also it's important to surround yourself with like-minded people. So if you're investing, you want to reach out to other passive investors, you want to talk to them, you want to reach out to other operators. Networking with other people in the space is important, because again, it gives you their perspective, and it opens up your mind to other opportunities and to other angles within the business as well, and gives you a better understanding of where you're heading.
Nice. So you met some potential investors, you establish a relationship with them, and now you realize that they are a good fit, right? And they will perform on the things that they said they will perform, right? Now the real work begins. Now you got to figure out how their money can make money. You know, so as we go on in this podcast, there is three things we want to focus on. We want to focus on vetting those operators that you choose to work with, also vetting the market, and also vetting the deal itself, right? So we're hoping to capture those three aspects of a real estate transaction as we go through the remainder of this podcast. So let's start with vetting the sponsor. What are some of the things you're looking for in a sponsor that you want to work with?
Sure. And by the way, I have a list of suggested questions that I share with investors that they want to use as a reference guide when speaking with sponsors and operators to work with. In general, working with partners, regardless whether it's passive investors or active, more so with active, it's more or less like a marriage contract. So when you're planning to enter into a marriage contract with someone, you know that it's a long-term process, hopefully a lifetime journey. And if you're entering on that journey, you want to make sure that, again, your interests and your goals are aligned with your potential partner. And if there are potential challenges and obstacles that will come up, and they definitely will come up, because every single deal has some sort of challenges that the team has to overcome. You can't anticipate everything, but it certainly makes sense to have the upfront discussions, have a very detailed operating agreement, and also it makes sense to have a number of upfront face-to-face conversations, and they can be Zoom like this or in person if it's possible to travel and you can meet the person. But understanding the person on the other end, track record, their strategy, how they approach challenges, and what they do in various situations is very, very critical. And having those discussions up front helps to determine whether the people that you're planning to partner up and work with are the people that you do want to enter into that long-term marriage contract, if you will. That's how it is.
You said marriage contract. I really want to bust out laughing, because we talked about that at work recently. Like, should a marriage, like outside of real estate, should a marriage be a contract? Like after 5 years, if things are not working out, can you break the contract, no harm, no foul, and move on? Right? We had a good 45-minute conversation about it. It was great hearing a difference in opinion. But anyway, that's a whole different topic.
Would engagement be the LOI?
I know,
Right, exactly.
It's like,
That's a good one.
That's funny. That's
yeah.
funny, Heath.
Oh man, I guess as you're scaling your business, or if someone else was to do something similar, is there a set of criteria? I know you have your questions, but is it more of a feeling you get after having conversations, or is it like, there's this one company that's been syndicating for a couple of years, they only have 2 deals, may not be someone you work with as opposed to someone who's done 20 deals over the course of 14 years? Is there some criteria in those regards with how you?
Absolutely.
Okay.
Yeah, no, absolutely, Heath. And that also involves reviewing the company prior work, evaluating the prior deals, how they've done business, how they were able to improve the overall bottom line, how they manage the investments, how much money they've made for the investors, do they have returning investors, what is the rate of returning investors, and referrals, because again, that also speaks for itself. If the company has a lot of referrals, that entails that the current investors are happy with the returns they're getting, and they bring in more business to this company. So that's important as well. And again, having several iterations of conversations and reviewing the deals and aligning on the strategy, all of that takes time. So definitely, I would not recommend anyone jumping into contract the next day you meet someone, but I would recommend taking the time and doing it in several sets, iterations, just reviewing where you started with this particular partner and how the conversation is going, and whether there is an alignment in terms of goals, and in terms of the next steps and the potential future investments that they're planning to make down the road.
We got a pool of investors. Now we found some other syndicators, operators we're willing to co-sponsor with or work with. What are your steps in analyzing the market? And do you also only work with operators in markets that you like?
Sure. Yeah, I try not to go and invest in a market that overheated and have more demand than possible, and where people are overpaying. But in general, when I look at the market, I look at several components. So I want to see the job growth, of course. I want to see population growth for a number of years. I want to see interest of people going into the market, and ideally the younger generations, the millennials and whatnot, because if millennials are coming, they'll typically come in because of quality of life and because of the jobs availability, and they're there to stay. That also entails having the infrastructure in the market. If the market has the infrastructure and can support that income flow of jobs and population, to me, it tells me that there is opportunity for growth, and it's only going to continue on that path to progress. I mean, look at Texas now. A lot of people on West Coast of California are not happy with the current developments and how their things are progressing. So I read a number of articles indicating that people are starting to seriously think about moving into Texas with several benefits. Number one is jobs. Number two, it's a tax-free state for income taxes, so that attracts a lot of people. And number three is the climate. I mean, it's warmer weather, and change of seasons typically is enticing factor, and a lot of people are attracted to that. So a lot of folks are considering moving from California to Texas these days. Probably not only from California, New York as well. For that very same reason.
I love Texas. I have to say, it's my favorite state. I was born and raised there, so there's a level of pride that comes with being a Texan.
Excellent.
Oh man! All right, so that's cool. So you got a lot of indicators in your market. It seems that having the infrastructure, jobs, the ability to support growth, and that there's been a trend of growth for a couple of years leading up. Following the millennials, that's a good tip. I hadn't heard that one, so I like that one. All right, so we've walked through. You got your pool of investors. You found some operators you like. You now know that they're in certain markets that you have found meet your criteria. Now it's time to evaluate the deal. So sponsor check, market check, deal. How do you determine what is a good deal or not?
There have been a number of executive summaries of offering memorandums, however you want to call it, the presentations of a deal that contain typos or grammatical mistakes. For someone who wasn't born in the US, when the first thing I notice is a grammatical mistake or a typo in a word, it's a red flag. And I wouldn't say it's a big no-no, but I would say it's not acceptable in a document offering someone to place $50,000 with them, knowing that the document has a mistake. I think spell check is easily available on all of the current programs, and everyone should be using it to their advantage. So, jokes aside.
No, but that is a good
That
point, and that is something. So in academia, when we submit grants to get funding to to the NIH to get funds for our labs and to fund the labs, that's one big thing that they, anytime there's a speed bump, that's what I call them. When someone who's reading the document hits a speed bump, and it takes them away from what you're pointing, they just slowly beat you up. And
Yes.
and if you can't take the time to find those little mistakes or before you put it out, how can you trust someone to not make those little mistakes on an Excel sheet with all the numbers with your money, right? So yeah.
Good point, Heath. That's another mistake number two. Excel mistakes. I've seen those. One of the examples is I've seen a deal from an accountant who sent me a potential syndication offering to take a look at, and it had mistakes in his Excel spreadsheet. So again, trust but verify. Verify everything. It doesn't matter whether a person is a rocket scientist or whatever their profession is. Everyone can make mistakes, so always verify that. Look at that.
Or a neuroscientist.
You throw me off. I'm sorry. So always look at.
Sorry to throw you off.
Look at two things. So the two things are the quantitative and the qualitative. And the quantitative obviously includes cash on cash, ROI, IRR, terms, loan terms, whether they have bridge loan or long-term loan, is it interest only, not interest loan only, but also the qualitative one. What is the operator trying to do with the project? What is their strategy? How they're planning to implement that strategy, and things that typically stood out. I'll give you an example. If someone is planning to do a heavy repositioning, then, and let's say it's 100 doors apartment complex, they want to do heavy repositioning. If I see a full vacancy being at, let's say, 10% year one and 8% year two, to me, that's a red flag. If you're doing heavy repositioning, your vacancy should be 18 to 22%. Because again, you're trying to turn the units, you have vacancy now, and if you're planning to renovate them, it's going to take time and resources. So don't expect your overall vacancy to be low. So that's a red flag to me. The same applies by looking at the overall income and expenses. If they're doing renovations, I don't expect that their income is going to grow fast, but I do expect their expenses to stay at the same level, whatever it is, 50 or 60%, so forth. So those are the things that you need to look at. See what they're projecting. Are they planning to do a cash out refinance at some point? and return investors' equity, what kind of pref is offered, and if preferred interest is offered to investors, is that cumulative? Because sometimes pref is offered, but it's not cumulative. If you're doing heavy repositioning, chances are you're not going to be able to meet that pref in the first year or two. So are you offering cumulative pref to investors so they can recover that interest down the road? So that's very important, and that also is a matter of being fully transparent with investors, because I want to see all of that in the executive summary spelled out, so people can see it, read and understand, and make sure that this is something that they're willingly signing up for. And then again, making it into a conversation, asking questions based on what you see on offering, and also hearing the story. Do they make sense? Is there a natural progression? Are the expenses all over the place, or are they gradually decreasing, let's say from 60 to 55 to 48 and then to 45% and so forth? So those are the things that I look for, and natural progression, enough cushion in each of the expense points, and enough cushion in the rent projections. Again, let's say market rents are $100 on the market. In a market like we are today, if I see someone bumping up rents by $100, I would be very surprised, because to me that's completely unrealistic. I would probably want to see the rents stay on the same level, maybe for a year or two, and not necessarily in real life, but at least on the underwriting. You might be able to increase your rent a couple years down the road, a couple months down the road, but maybe not. When I look at the underwriting, I don't want to see that. I want it to be as conservative as possible, to make sure that we're able to get through the tough times like we're going through it.
Yeah, you made two great points there. One is about
Only
the
two?
pref. Well, no. Sorry. Two. You made two great points that I that speaks to me a lot. That I was going. One is about the. That was great.
It's a good one.
Thank you.
Okay. One is about the pref. We've vetted some deals lately where they're like 6-8% pref, but then when you look at the underwriting, you're like, you can't even get cash on cash return. You can't even you don't have the funds coming in to justify a pref. You're going to be in a deficiency to pay off that pref for 3 years. And I think it would be misleading to the people that you're going to be getting 8% from day one, when that's really not the case. You might be getting 1.5 or 2 as they're going through their renos. I already forgot what the second point was.
Sorry.
No, it's all great. I love it. Oh well, I if I think about it, we'll come back to it. But
so I guess it's only one point then. Heath. that was a good one. That's a good one. What is life without a little bit of laughter, right? So,
Yeah.
Alina, really appreciate all the information. There's absolutely no doubt that you are looking out for your best interest of your investors and your business as well. So, from the initial inception, the initial conversation, all the way to putting their money to work. And it's amazing that you were able. It's amazing that you take the time to give us insights of the way you think and the way you run your business, and that's great. So we're gonna dive into the focus.
I know
round.
the second point now. I remembered first. If we'll see. The second point is a lot of times brokers send you OMs, and if you get one from a sponsor that has $100 rent bump, and implementing rubs, that's my first sort of check where like, oh, this is someone who doesn't really understand what they're doing, or they're being a little bit too aggressive, because doing $100 rent bump and then adding $45 in a water bill is effectively causing the tenants to pay $150 more than that they normally would, and that's usually not supported. So that was my other thing. Sorry.
Yeah, because at that point, that property would be priced out of the market, right? So you might not be able to achieve that business plan. Just a great point. All right. Yep. So, Alina, we're going to dive right into the focus round. All right. I'm not sure if you listen to any of our shows, but it's a focus. It's kind of a fun opportunity, communication, understanding, and success. Right. Awesome. So I'll start off. What do you do for fun?
We go hiking as a family.
opportunity. What is one opportunity that was a game changer for you?
It was one of the opportunities I invested as a passive investor many years ago. We received half of the equity back in year 2, and it was a game changer. I mean, getting my money back without having to pay any taxes on it because it's my own money, but having that physical check in hands, it was a huge game changer. I love it.
What is your most important communication tip?
You will never over communicate. So communicate and be as transparent as possible with your investors.
What is one thing you wish you understood earlier?
I wish I started investing when I graduated from college, which was go.
That's great. To what do you attribute your success, Alina?
To the people that are surrounding me, my family, friends, and many successful real estate investors and other entrepreneurs that I've met throughout these years. I wouldn't be where I am at today without all these people. And I truly believe, as I forgot who said that, but you're a true reflection of the 5 people that surround you. I think that's definitely a true statement. I live by that.
That's right.
Amazing. All right. So if our listeners wanted to get in touch with you, how would they go about doing that?
They can Google me. They can find me on samofinancial.com or Bigger Pockets, LinkedIn, Facebook, or Instagram.
Okay. You also have a book library.
I do. I do.
You want to talk about that?
Compiled a list of books that I've read over the years that have helped me. And I share that library with other people. They can go and look at my list and see whether any of the books interest them and read them. And if they go through the links on my website and buy the book on Amazon through my link, then I get a small portion of commissions, which will benefit children in need. I don't collect those money. I send it to local charity to benefit local kids in the country that supports the kids.
Well, that's
Nice.
amazing. That's really awesome. All right. So check out the book library and purchase some books and help some kids out. Awesome.
Thank you.
Well, thank you so much for joining us today and speaking with us. We appreciate it so much. We know time is very valuable. So thank you again for joining us today. It was very pleasure talking with you. I'm Dr. Heath Jones.
I'm Hutch, the Marine Investor. Out.
Thank you, guys.
All
This was
right.
amazing. Thank you so much.